Okay, so there's this quiet revolution happening in the world of blockchain. The original engine, the one that powered Bitcoin and basically set the blueprint for a decade of innovation, it's being replaced. We're going to dive into what this massive transformation is all about and why it's all happening right now. And that's a really good question, right? For more than 10 years, the original model was the undisputed king. So why has the momentum shifted so dramatically? Why are so many new projects and even huge players like Ethereum making this big switch? This isn't just some small technical upgrade, it's a fundamental change in philosophy, and it's being driven by some really powerful forces.
And one of the biggest forces behind any big change is money. And we're talking about big money here. And just their first year, Bitcoin ETFs pulled in over $50 billion from institutional investors. These are your pension funds, the major banks, the kinds of players who aren't just looking for returns. They want sustainability, they want efficiency, and their arrival is absolutely changing the rules of the game.
So, to really get what's going on here, we got to talk about one core concept, the consensus mechanism. Just think of it like the rule book for a team. It's the process that lets thousands of computers all over the world agree on what's true, all without having a boss in the middle. It's the very engine of trust in a decentralized network.
All right, so let's start at the very beginning with the original, the one that kicked this whole thing off, proof of work. This was the stroke of genius inside Bitcoin that made decentralized digital money possible for the very first time.
So, how does this thing actually work? Well, imagine a global, high-stakes puzzle competition happening 24/7. These miners are all racing to solve an incredibly difficult math problem. The first one to crack it gets to add the next page of transactions to the ledger, and for their effort, they get rewarded with new coins. It's this work, all that computing power, that proves they're legit and keeps the network secure. And look, for years, proof of work has been the absolute gold standard for security. It is battle-tested. Networks like Bitcoin have been running for over a decade, securing trillions of dollars in value without ever being successfully hacked. To take over the network, you'd need a truly impossible amount of computing power. It's just incredibly robust. But, and this is a huge but, that fortress of security has a pretty big crack in its foundation. The very same computational work that makes it so strong comes with an external cost that, frankly, the world just isn't willing to ignore anymore. I mean, the scale of this problem is just staggering. Bitcoin mining all by itself uses about 0.5% of all electricity generated on the planet. That is more power than some entire countries use. And as the network gets bigger, so does its energy appetite. This has really become its Achilles heel. So in response to this pretty massive flaw, a challenger stepped into the ring, a completely new way of thinking about consensus. One that was designed from the ground up to give you security without that colossal energy bill. And that challenger is called proof of stake. So instead of miners proving they're serious by doing all this computational work, proof of stake has validators who prove their commitment with capital. They lock up, or stake, their own crypto as collateral. It's kind of like putting down a security deposit. If you play by the rules and validate transactions correctly, you get a reward. But if you try to cheat the system, your deposit gets taken away. You literally have skin in the game. Okay, so this table right here really breaks it down for you. Proof of work needs that expensive, specialized hardware for mining. Proof of stake, it's all about investing capital, and you can run it on a pretty standard computer. But just look at that energy use row. That is the game changer. We're going from extremely high to basically nothing.
I mean, how low are we talking? Well, when Ethereum, the world's second biggest blockchain, made the switch from proof of work to proof of stake, its energy consumption dropped by an estimated 99.95%. That's not just an improvement, that's a whole new paradigm. Yeah, this chart, it really says it all, doesn't it? That skyscraper on the left, that's proof of work's energy footprint. And on the right, that tiny little thing is proof of stake. It's such a massive reduction that it basically flatlines the chart, and that is the single biggest reason for this whole industry-wide shift. But of course, it's not that simple. I mean, is anything in this space ever simple? This incredible leap in efficiency comes with some serious trade-offs, and it sparked one of the fiercest debates in the entire crypto community. This quote, pulled right from a community discussion, really gets to the heart of the criticism. See, the way a network creates and hands out its new coins is fundamental to its whole economic design. And in this area, proof of work and proof of stake are from different planets. And that brings us to what people call the rich get richer argument. In proof of work, miners have real-world electricity bills. They have to sell their new coins to cover those costs, which constantly pushes those tokens out into the market. But in proof of stake, the validator's running costs are super low, so they can just hold on to their rewards, stake them again, and basically compound their earnings, letting them grab an even bigger share of the network over time. And listen, this isn't just some theory people are worried about. This question, taken from a real online debate, points to a real-world example. LIDO is what's called a liquid staking service, where lots of people pool their funds together. It's super convenient, yeah, but it's also led to a situation where one single entity now controls a massive chunk, like around 30% of all the staked Ether. So the big takeaway here, the real risk, is centralization, the very thing blockchain was designed to prevent. If a handful of big exchanges or staking pools end up controlling most of the stake, they could gain way too much influence over the network. And that challenges the whole promise of this being a decentralized system for everybody. Okay, so we've gone through the tech, the energy debate, the centralization risks, but what does all of this actually mean for you? Whether you're a user, an investor, or a builder, why should you care on a practical level? All right, so let's break down the key takeaways for you. First, crypto is getting greener. This shift directly tackles those big environmental concerns that kept a lot of institutional investors away. Second, it creates new ways for you to earn. Literally anyone can get involved by staking their tokens to help secure a network and earn rewards. No giant data center needed. That massively lowers the barrier to entry. But, and this is the big thing to keep an eye on, you have to watch the growing power of these large, centralized staking services. And you know what? We should remember, it's not just a two-horse race here. The innovation doesn't stop. You've got pioneers like Decred who are building these cool hybrid systems. They're trying to get the best of both worlds, using the raw, battle-hardened security of proof of work for making blocks, but then using the efficiency of proof of stake for things like governance. The search for the perfect model is definitely not over. Okay, so where does all this leave us? What's the big picture for the future of how these decentralized networks are going to be run? You know, the story of this whole shift, it really boils down to 3 simple steps. 1, the energy problem with proof of work just became unsustainable. 2, proof of stake showed up as a workable, super efficient solution. And 3, a flood of institutional money came in demanding assets that met their environmental, social, and governance, or ESG criteria. That focus on sustainability was like pouring gasoline on the fire, pushing the whole industry toward this new model. And that leaves us with the million-dollar question, doesn't it? Is this huge migration to proof of stake actually paving the way for a cleaner, more accessible, decentralized future? Or, in our race to solve the energy crisis, are we accidentally creating a new class of rulers, concentrating power not with miners, but in the hands of the wealthy? The final chapter of the story is still being written.